Okay, so we're going to talk about accounting concepts. Now, obviously, we don't expect our clients to be accountants. That would be pretty pointless paying us. It's not that we want to turn you into an accountant. It is a fact. It's just the fact that we think our whole philosophy, the reason our business was started, was to help businesses to understand their finances and to develop financial controls within the businesses. There's actually we have actually lost clients where we've got them to the point where they or their team are upskilled to the point where they don't really need us anymore. And I don't take that as a negative. You know, I'm quite happy for that to happen. It's really about the values of our business and what value we can bring to other businesses. So with that in mind, we always try to promote the involvement of business owners and managers in the finances of the business. We do meet clients that say, well, I'm not financial. Now, you kind of, you know, giving yourself a bit of a get out when you say that, because if you run a business, you need to be financial. You don't need to be an accountant, but you need to be financial. You need to have at least a certain level of understanding of finance. And it's no coincidence that those businesses run by people who do understand finance, to some extent at least, are generally more successful than businesses where that isn't the case. It's also no coincidence that 8 out of the top 10 of the FTSE 100 companies at the moment anyway have an accountant as their CEO or managing director. And it's, you know, I've worked for loads of businesses where, bigger businesses anyway, where the MD or the CEO was formerly the finance director, or was formerly a finance director or an accountant at another business. Because, you know, having that level of understanding of finance, as we preach all the time, helps you to understand everything about your business, because everything in your business has a financial impact. So you're doing yourself a disservice if you just write it off as, well, I'm not financial. I pay an accountant for that. So having said that, let's get stuck in. So there's only three accounting concepts that I believe all business owners should know. So again, we're not trying to say you're an accountant. We're not going to teach you all the accounting standards that an accountant needs to learn, and all the processes and theories and all the, you know, everything that goes with it. But there's just three that really are fundamental to the understanding of a business owner when it comes to finance and financial controls. It also feeds the performance valuation and this control cycle that we talk about in our other videos and in basically all of our work. So the first of these three concepts is double entry accounting. Double entry accounting is the standard across the world when it comes to accounting systems. Everybody uses it. Unlike all of these accounting concepts, which not always everybody uses, but this one is a given. If you're doing accounting, any accounts are prepared on the basis of double entry accounting. And the basis of double entry accounting is the accounting equation, which we'll look at in a minute. But it's really the reason why double entry accounting is the standard system. And then the third concept is the accrual accounting convention. It's a bit different because the first two are all about numerical accuracy. The third one is about the accuracy of timing, which is just as important from all aspects. You know, given that as far as HMRC are concerned, but also from my point of view, it's the most important element of a business is the correct calculation of profit in a period. The reason HMRC want that to be the case is because of tax, because they want to make sure you're paying the right amount of tax based on the profits. From my point of view, it's about performance evaluation. You can't gauge how your business is doing unless you've calculated the profit accurately, not just numerically, but also in the right period. So that's why these three accounting concepts are so important. So just to quickly, I mean, we're going to do a separate video on each of these, but just to give you an overview of what they're all about, or a summary in this video. The reason we're doing separate videos is because you may be familiar with one or two of these, but not all of them. So rather than making you sit through a big presentation about all three of them, we're going to do them individually so you can pick and choose which ones you look at. So the first one, the accounting equation, literally boils down to assets minus liabilities equals equity. Now, for the purposes of this calculation or this equation, equity loosely translates as profit. So assets minus liabilities equals profit. It's not always the case. There are other equity elements in there, but we'll go through that in the specific video about the accounting equation. But that's what it boils down to. Assets minus liabilities equals equity. So double entry accounting, the you may have heard this mantra: for every debit there must be a credit. So these are the two sides of an account of any transaction. Every transaction in your business has a debit which increases value and a credit which reduces value. So again, we'll go through that in more detail in the individual video, but that's what double entry accounting boils down to. And the reason I said earlier it's based on the accounting equation is because if you look at the three elements of that equation: assets, liability, and equity, every transaction will debit one of those and credit one of those. And that's how it keeps it all in balance. That's how that equation balances, because there is always an entry on one side and an entry on the other side, hence double entry. And the accrual accounting convention, as I said earlier, it's about timing. So it's ensuring that costs and revenues are recognised in the same period and in the correct period, because the accrual accounting convention stipulates that any costs relating to revenues should be recognised in the same period as those revenues. And again, we'll go through that in more detail, do a few examples, but that's it in a nutshell. Now, the reason I think it's so important that all business owners understand these concepts is because they're an important part of your performance evaluation. For you to correctly evaluate that performance, you have to do it in the same way that your accountant would do it. You know, when we've talked in other videos about the 20/60 rule, the reason for the confusion when people get their year-end accounts and it differs from what they thought they did, the reason for that is because they're not working to these principles. It's a fundamental cause of that difference of perspective. You know, your accountant uses these principles to create your year-end accounts. If you don't use the same principles during the year, then there's always going to be a disparity or a disconnect between what you think you've done and what your accountant files with Companies House. So, and ultimately, what goes to Companies House is the official record. So it doesn't really matter what you think you did or what your accountant thinks you did or anything else like that. Ultimately, it's a case of this is the matter of record. Once those accounts are on Companies House, that's what it is. So yeah, these concepts are a vital part of performance evaluation, and they are what creates that flawlessly reliable assessment of the performance. So if you've watched any of our other videos or you've done our training courses, when it comes down to the flawlessly reliable performance evaluation, this is how we achieve that, by using these three accounting concepts. So if you want to know more about them, as I say, there's individual videos on each one, so check them out and, hopefully you'll learn something.